Most new investors chase the highest yields they possibly can find. But the secret to building some sort of dividend wealth and passive income is actually in the dividend growth. It's about holding companies that are quality and, more importantly, increase their dividends every single year. So in this video, I've found 7 that are not my own, that do increase their dividend yield. And I'm going to also show you the tool that I'm using to find a lot more things based on numbers you provided. If you like this sort of stuff, please do leave a like and comment what your favorite stock is that does this. Now, if you follow along, you'll know that this is my portfolio. The backbone of my portfolio is to have ETFs for growth and individual UK-based stocks that offer a dividend yield for the most part that's relatively good, but more importantly has an element of growth. So in terms of this, let me explain it. Dividend growth over the 5 years, all of them, apart from one, essentially, or two, you could argue, has zero dividend growth over the last 5 years. Some of them do have over 3 years, so it's okay, but that's an average over 5 years. Now, this is a thing. A high yield now isn't as effective if the dividend growth is not growing, because you want to have a thing that increases yield on cost. That is important. So over the course of a 5 to 10 to 15 year period, that yield on cost wants to kind of grow. That will give it a compounding effect. And over time, with capital appreciation, you will get a passive income. Let me just kind of showcase one thing on mine. So just to go to the dividends here on Snowball, by the way, link below if you're interested. There's a discount as well. Jump in. Yield on cost is up a little bit. My portfolio has had a bit of a hit over the last couple of weeks with 2 of my holdings, which is basically Hilton Food Group and obviously Hikma. However, that being said, most of these stocks have a growing dividend, which is important. So it's only this, but 40% of my wealth is in a growth index, which is an ETF. It makes sense when you look at the bigger picture, but what you want to have is some pillar points on your portfolio that are growing. And most of my stocks grow their dividends, which over time will allow me to get passive income as it compounds, as it grows. So on average, my portfolio dividend growth is 6.48% without capital appreciation. So the numbers will keep growing. So let's get into some stocks, okay? Some stock picks. Spirex is the first one. Now, the reason why this is on here now, it's not an amazing stock in terms of the overall numbers on Stockopedia. By the way, link below to this, you get 25% off. It's an amazing tool. It will find you stocks without any sort of hesitation. It's a brilliant bit of kit. But let's go through the nitty gritty. Now, what I've done here, I've picked a load of stocks that are not my own ones, and it gives you more options. Now, with this one alone, essentially, right, let's talk about the obvious in the room. This has a really decent dividend growth CAGR. It's 6.66%, which is relatively strong. And as you can see over the course of time here, it is growing quite nicely. However, not amazing, but it's still growing. As you can see, though, it has been growing for quite a while. So roughly, we're talking an 8.45% on average, which is quite decent considering what it is. And that's what I mean. It will just continuously grow. And there's no real dramas with that. And its yield is actually relatively strong too. Now, the next one is Cohort. Again, you could argue good momentum on this one, good value as well overall. But this one has a 10.14% CAGR, which is pretty decent realistically. And that's over a 3-year rate, okay? So with this, the dividends are growing pretty nicely. And overall, yes, the yield is quite small. And that's what I think, for me anyways, and seeing it in the comments, a lot of people get put off by, oh, it's really low yield. But you got to think 5 years down the line, how the cost and the yield on cost of that will massively snowball over time. So you need to have, as I say, a mixture of ones that pay a good yield now, that still grow, and also ones that are quite low and paying, or will be paying, much higher in the future. Now, that's the thing. With this, right, with this stock, everything's looking relatively good in terms of the health, and because obviously it's got a 73 rated on the quality here, right, which is important for the quality of the stock, and it's more around the technology side of it. But as you can see, it is growing, which is kind of important. Now, another company that you probably have heard of, good quality, 80 ranked, momentum's increasing, but you could probably argue value is pretty low. So you may not get much value appreciation here. However, going down to the dividend side of it, the growth on the dividends is absolutely boggling. It is one of the top performers over the last recent history. And yeah, you could argue it's slowed a little bit, but ultimately that dividend yield will gradually grow. And, you know, the CAGR's doing relatively good. As you can see here, the compound annual growth rate is absolutely flying along. And that's the thing. revenues have increased by 34%. So it's still doing well, still doing bits. And as you can see here overall, when you look at the dividend side of it, it's just growing. That's kind of what you want to see throughout. By the way, I did a video not too long ago regarding obviously dividends and the growth and how Warren Buffett made money. Imagine buying this back in like 2014 or something like that. Look at the state of that. 0.8 to now 9p per share. What on earth? Now, a super stock, technically on this platform here, is Rathbones. Now, a bit of a odd one to kind of explain what this is, but overall, I will kind of keep it as simple as possible. This is a large cap dividend stock, and it qualifies for one of the long streams. And as you can see here, overall, this is relatively strong. Now, again, you could argue, overall, the growth has been pretty strong, and its yield is actually pretty high. So if you're looking for something with a decent-ish yield today and a growing dividend yield, this is really decent. And as I say, it's a bit of an interesting one because it is all about investment and wealth services for private clients, charities, trustees, and professional partners. So it's all about wealth and money making, right? They're pretty strong in the UK right now, realistically. Now, the fundamentals, obviously, of that is important, but also as well, its dividend target in terms of this side of it is 28 out of 94 companies in the banking and investment sector. So again, you can argue with this button here. If I click on here, that's what it obviously means. I've obviously been talking about it, but ultimately, it's important to note that over a 3-year period, it is doing relatively good. And as I say, the dividend yield is pretty decent. So just be mindful of obviously volatility in terms of the market, but ultimately the dividend is paying some pretty decent stuff already today. Now, Winstay, I think I've pronounced that right, is a pretty strong stock. It's ranked 97. It's got good momentum. It's got good value as well, realistically. So it's not really like crazy value-wise, but ultimately it's got really good quality. Revenue versus market cap is relatively high as well. But with this is interesting, right? So as you can see here, again, dividend yield is roughly around the 4.7%. And the dividend growth is actually just trickling. Nothing crazy, but it's a really solid stock that is growing and trickling over the course of time, as you can see here. So again, it's another one of those stocks that is just trickling up nicely, one of those quiet compounders that's probably going to be very, very important. Now, again, the CAGR is not amazing, but it's still growing over that 4% mark. And if you're looking for a stock that is over that 4% mark, it's pretty interesting. Now, this one's an interesting one, right? It helps with livestock, fertilizer, seed. It's got a load of different brands and stuff like that. So that's important. But more importantly, it's a part of an industry that could be very well niche longer term in terms of the UK side of it because of obviously tariffs and stuff and that kind of incentive to try and grow your own food and stuff like that, and UK-based companies doing the business. And when you look at their main website here, it's pretty important to note one thing and one thing only. It's been around for a very, very long time. Now, another top company, in my viewpoint, is Superstock. It's a mid-cap. It's all about, obviously, safe store. But the thing with this is, which is a hugely important factor, I think these sort of companies are overlooked, personal opinion. The reason being, we need them. It's kind of obvious. But with this, obviously, the momentum of the entire stock is quite low at the minute. But realistically, look at the revenues, really strong, growing, right? And even when we talk about the dividend growth over the course of the last few years has been pretty aggressive. Apart from recently, it's been a bit slow. But even today, when you look at the obvious in the room, I know, it's still paying you a 5% dividend yield. But over the course of the dividend CAGR, 10.16%. Even here, 3% increase in revenue, pretty important. And, overall, it's pretty much highly rated in terms of its sector. And that's the thing. When we talk about where it is in terms of its industry, it is absolutely flying in terms of operating margin and stuff like that. And it's all green across the board in terms of quality. So its return on capital is pretty damn strong. So yeah, you could probably argue more and more dividend yields are going to get increased there. And the final one, and probably the obvious one, but the one that is probably going to be on the most scrutiny is United Utilities because of its energy and water and stuff, and the kind of tied in with the government, and it could be a bit wishy-washy, right? Now, again, you could argue a lot of things, but overall, its dividend growth has been slowly growing over the course of time, and it's only just at 4%, which isn't amazing, but it kind of does its thing. The DPS, realistically, on dividend price per share growth is 6%, and it is actually number one, right? That's fine, but there isn't much competition here, so it kind of is like a monopoly. But as you can see, growing a decent dividend yield, it's growing as well. And the price in terms of momentum isn't amazing, but it could be a lot worse versus other government related stuff, which is fine. Just be mindful of it. Obviously, the press can cause issues here, but you get the idea. So in terms of how I found these, this was all on Stockopedia, but I want to kind of showcase how you can change the numbers a little bit to kind of make them work for you. So we can go through it in more detail. As I say, there's a link below to this if you're interested, you can start on a free trial too. Now, let me just talk through what I've done. So all I've done on here is a 7-year growth streak with a DPS CAGR on 3 years over 4%, okay? Now, as I say, you can change this. If you wanted to, you can have this over a period of longer, i.e. 5 years. So if I just put 5 years, it's going to remove 1. That's fair enough, right? But if you wanted to go a little bit more aggressive and go 5, which would be a bit more like, ooh, these are super growing stocks, or even into 7%, you're only going to get 26, which is very, very low if you're in the UK. Obviously, if you've got the US side of it, it's different. Now, again, you can argue if you want to go an extra year or so, you can. It's entirely up to you. But the fundamentals are very clear. This is where the dividend growths are. Now, the reason why I've picked the annual growth streak, it's important to note because this is where the streak of it is growing their dividend. So, i.e., how many times in a row are they growing it? That is where it's interesting. Now, for me, you can change that if you want to. You don't have to have them as growth. Let me see what happens when you remove it. So when you remove that and you only pick stocks that have a per share dividend CAGR of higher than 7%, you get a lot more. But the difference is, and the issue with it technically, you may find that they may skew the data a little bit, where they may grow it by 80 or 70 or 60% once or twice, but they may have a lot of losses as well. You don't want to have a situation where technically, realistically, what's going to happen is you're going to find skewed data. So let me give you an example. So this is STB, Secure Bank Trust. I have no idea what it is, but realistically, it is technically a super stock. Enterprise value, a bit negative. Quality, quite low, but the value of it and probably the momentum of it is, basically what this is telling us that it's been really low, it's speculative, and it's bounced, right? But overall, you can see some of the data is pretty, it's a bit, you don't want to be fully looking at this thinking, oh, that's all right. So when we talk about the dividends, as I say, you had a minus 75 plus 120, 38. You get the idea? It's going up, but it's very much up and down, up and down, up and down. You want it to be a bit more reliable. But as you can see here over the course of time, it's not really growing, it's not really doing anything. So it will skew the data. That is a bit of a problem. So as I say with this, yeah, there'll be some great stocks in here. You will have to go looking. But even some of the stocks that I have, they're not perfect. But over the course of time, so for example, Mighty with me, it's a good stock in my viewpoint. But overall, you can see that sometimes they do bad. But that was COVID. COVID was a bit of a weird one. It has came back off that, but over the course of time, it did really well. And then we had some issues in this time period, and then it's going back up again. Not all of it is doom and gloom, remember that, and that is why you need to do your research and find stuff. But ultimately, yes, you can just go for growth CAGR on its own. But as I say, there's so much information here you can get your mitts on, so to speak. So other things we can add on here to kind of refine this to kind of filter out some noise, right? If you wanted a certain dividend yield, right? So if I go add rule here and go dividend yield, if I wanted to only get over 3% yield and they are growing, that will give you a decent yield for today, but also it's growing for the future too. That could be a really solid one. Other things we can also do. So if we remove that and go add stuff, if we go stock ranks, we can also look at different stock ranks here and allow us to find different things. Now, if you've been following my channel, there's something that I like on mine, which is a bit mad. I like this one. This is basically everything plus growth, and it allows me to see certain things. So if this is over, say, 70, it will give me a lot of stocks that are actually relatively decent, i.e. they have good growth and, good quality, good value, and obviously momentum more to the point. So they're not shite, basically, long story short. So that will kind of help. So it's entirely up to you. But as I say, you can pick a portfolio base of this alone, and then you go from there into the ETFs and figure out the ETFs, and you can get individual stocks that you pretty much trust that are not going to give you wibbly wobbly data. But you're probably wondering one thing: why DPS growth versus DPS CAGR? They're very different, right? One of them is dividend per share growth on year growth of the dividend paid by the companies, calculated on year dividends per share. So yeah, it's important, but this is the thing. That said, some companies do not pay stock dividends at all. Rather, they use excess profits to reinvest. Important. Now, when you talk about the CAGR, this is different. This is the share compound annual growth rate. So essentially what this is doing is giving you the consistent payments indicate a company with a certain level of financial stability. If the companies are able to frequently increase their dividends, this may be a sign of financial stability and growth. That one's a little bit better because it's giving you the reinvestment of a really healthy company and it's showcasing the compounding effect. Whereas, yes, as I say, you can go with this one if you want to. It's entirely up to you. But a lot of it can be forecasted from the past. And if I go add rule on here, right, and we do the exact same thing, and actually what we're going to do here, we're going to remove this one and do that one, you get the same sort of vibe, but you may get a little bit worse in terms of data, if that makes sense. Because overall, some of these are crazy numbers, by the way, absolutely boggling numbers. So just be mindful of that. These are the sort of things that I look for. If you, as I say, if you want to use them tools that I've been using, there's a pinned comment which will give you access to them as well. And most of them and everything that I use tend to come with a free trial anyways. But the thing is, with dividends and the growth of it, you won't become rich overnight. That's obvious. It is a very much a quick, rich, slow, but quietly snowballing over time. If you can pick a quality company based off their balance sheet that is reliable and financially stability is there at the forefront of their future, you can get a dividend growth that will continuously grow over the course of time. Yes, you'll have periods where things will go a little bit wrong, but more importantly, most of these that you're picking, if you're filtering them out anyways, they tend to be quite reliable, which is hugely important. You don't have to have 50 different companies. You just need to have, a focus on 10, 12, and then a decent ETF. Obviously not financial advice, of course, but ultimately, the more research you do, not just watching videos, and the more platforms you use to kind of get a good idea, you can make better informed decisions. That will help you massively longer term, committing to it, and more importantly, understanding the factor of why dividends are important, why they get reinvested, and more importantly, why you need them, not so much with growth as well. So if you enjoy this sort of content, please do subscribe, follow along with my own dividend portfolio journey, and I will be reinvesting a bit more in the next couple of weeks as things get a bit more interesting.